right? So all this time, everything that I have been speaking was not recorded. And then that's why I'm telling you, because I need to I need to get things, settled first. And then when you're, when you keep just speaking like that, keep speaking without listening to me, then I can't organize. I can't organize any conversation. So when I say hold on, please stop, pause, and listen. Now, again, so the point is, when the company isn't growing, right? That kind of, and you said IBM, it's not that IBM is not growing, right? IBM is still, it may not have a significant growth rate, but it has, if it is not growing, um, it will still have some growth, like, not like 10% a year, but at least, something like 2% a year, or otherwise the business would shut down. Don't you think? Growth in the business means it's generating revenue that is greater than cost, right? They are generating revenue that is greater than CGS and OPEX, so that they would have, so end result is what? They have positive profit. EAT is positive. Only because EAT is positive, stockholders are still holding their stocks. If it is not growing, and if it hasn't shown growth for the last uh, uh, 5 years, this is very, very serious, and they will dump the stock. And besides, the problem is, if the revenue isn't growing, what's another problem? Look, there's depreciation every year, every quarter, every year there's depreciation. And suppose, so there is no revenue. It's not generating enough revenue to cover for depreciation. I mean, think about it. They have employees, they have plant and equipment. Employees and plant and equipment would be producing something. They will be, and the company will be paying them. And equipment expenses for the equipment, that's depreciation, right? And if the revenue doesn't cover this, then their profit is negative. And if they barely cover it, then the profit is zero. So if the profit is zero, or if barely covers the, if it doesn't even cover the expenses, then the profit will be negative, or company will be incurring loss. And if they keep doing this for several years, then already from the first or the second year, right, the shareholders will sell stocks, right? Shareholders will sell stocks, and stock price will already reflect that. The stock price will drop, and as it continues to drop, the rest of the market will catch on, right? And the only reason the stockholders are holding on to the stock is because this company's profit is growing. And if it is growing, it will be reflected in the elevated stock price. Okay? So if any company that is in, let's say this is stage 3, right? Stage 4. Okay, stage 1, stage 2. If it is already into 3, think about it. The future of this company is obvious. Then you wouldn't be, as an investor, you wouldn't be interested in investing in a company that is in stage 3 or stage 4. So that's why variable growth model is considering only these two stages, right? Make sense? All right. That's okay. And since Wing asked the question, I hope.
Thank you.
All right, you're welcome. All right. Okay, so unless there's any other questions, let's, move on and pick it up from where we left off yesterday. Okay. All righty. So where am I? Okay, so we were talking about the free cash flow model. The free cash flow model, I told you, is something very uh, something very useful when companies don't pay any dividend, because also valuation models are basically dividend discount model. But as I told you, dividend is not a must, right? It's not a dividend is not an obligation. So some companies don't pay out dividends. If they don't pay out dividends, then how do we value it? And then we value it by free cash flow, and it's pretty much discounted cash flow model. So what discount rate do we use? It's weighted average cost of capital, right? That's what we were discussing yesterday. Okay, let's continue. Right, makes sense. And if the equity once again breaks down into common stock and preferred stock, and also the proportion of common stock and preferred stock, usually, so anyway, so let me. So that's called so in other words, what you need to do is the capital structure. In other words, equity ratio, right? 60% times required return plus the debt ratio, 40% times the cost of debt, right? And that is called weighted average cost of capital. So this RA represents weighted average cost of capital, right? Let me use that. Okay, try. So what that means is, what is weighted average cost of capital? Weighted average cost of capital is weight of equity times cost of equity, which is the required return, plus weight of debt times cost of debt. That's that, right? That's weighted average cost of capital, okay? Now, so then this is also a kind of multi-step model. Why? Let's take a look. So let's take a look at this example. Dewhurst Inc.'s data for the free cash flow valuation model. First of all, we have the free cash flow forecast from 2013 through 2017. So 4 years, right? For the next 5 years, actually, forecast now, or 5 years. And then, so there's no dividend data because this company isn't paying dividend. Other data, the growth rate of free cash flow beyond 2017 to infinity, the growth rate of cash flow is 3%. That means, beyond 2017, you will, what does that mean? You will apply 3% to this, and then that will be the 2018, and right, and so on, right? And they gave you a weighted average cost of capital as 9%. It's already given, so makes it easy. So value of debt, 3.1 million. Value of preferred stock, 1,000. I mean, if they wanted to make this example very hard, they would have done it. They would have made it very hard, and they would really give you a hard time. But they wouldn't even give you the weighted average cost of given. They would make you calculate it, actually, based on the capital structure. And the number of shares outstanding, common stock, right? The number of shares of common stock outstanding, 300,000. So it's almost served on a silver platter. Everything is provided. All you need to do is and from this. But how do you proceed from here? Look, this is the clue. Growth rate beyond 2017 to infinity. That means what? And it's constant at 3%. Growth rate of free cash flow, constant 3%. Doesn't that ring a bell? Although this is not dividend, but it's the golden growth model. It's the same pattern, right? Golden growth model. So that means use golden growth model beyond 2017, right? Right after 2017, right? Use the golden growth model, and for the next 5 years, the cash flow is projected and it's given to you. So what do you need to do? Just like in the variable growth model, you find the present values of these, combine it with the golden growth model, right? And then that's the value of the company. Well, you discount it all the way back to 2012. That's the value of the company as of 2012. And then what do you need to do? You will need to then isolate only the value of the common stock, and then that's the value of the equity, common equity, aggregate, and then to find the price per share, you divide it by number of shares, right? So they did it, in the slide. A lot of things were done there, but let me quickly. What's important is do it using Excel. So let me. So it's pretty much like the variable growth model example, right? First of all, year 1 through year 5, free cash flow, I discounted it to present. I found the present values, right? So then you might wonder, present values there, but why are they in why the projected cash flow duplicate there? Well, it was a duplicate, right? I had to make a duplicate because of this. You will see year 5, it's not a duplicate. Why? It is suddenly different. Why? It's because of this. Now let's see why. So first, we need to find the present values of all these free cash flows. Step 2, then we need to forecast the free cash flow in 2007. Why? Because we're going to use golden growth model. We need one more year on time t plus 1, and since it grows at 3% constantly, a constant rate of 3%, then all you need to do is this time 1.43. There you go. And then using golden growth model, that's the required return, or weighted average cost of capital. So dividend at time t plus 1, it's not dividend, but free cash flow at time t plus 1 there, or R minus G, right? R minus G. So then what is that? That's the value of the company.
Okay, it looks like the slide image and the illustration do not quite go together, but this is the if you go to Excel, you will see what I did with the free cash flow model. First of all, we all know, right? These free cash flows for the next 5 years have already been, the forecast has already been generated. So we have the forecast, right? And I just repeated it here, and you might wonder, why do you repeat it there? I mean, it's the same number. No, just for, don't you need to just, find the present value of those free cash flows? Yes, but look at the last year. These two numbers are different. Why is it different? Because I found, look, free cash flow beyond 2017. In other words, free cash flow forecast of 2018, which was done by, just like what we did with the variable growth model, but the only difference between the variable growth model and free cash flow model is that the data here is free cash flow, not dividend, right? So we make a forecast of 2018 free cash flow by, using the growth rate forecast beyond 2018. And from 2018, it's going to grow, right, at 3% indefinitely. So based on that, using golden growth model, right? Using golden growth model, the present value of the future cash flows, all the future cash flows beyond 2018, right? I mean 2018 included, and the present value of that. And the present means 2017, because golden growth model is a one period model, right? So with 2018 dividend data or free cash flow data, you want to define, or you want to you want to find the value of the stock, right, of 2017. So to generate for this forecast, this was your, time t. This is time t plus 1. So all that you can find is the value of the company. So value of the company as of 2017. Then since this is 2017 value, I added it to the free cash flow of forecast of 2017. So that's why it came to this. And then all you need to do is then find the present values of all of these. Just drag it down and then sum everything, right? Sum everything. And then this is what? This is the value of the company as of 2012, right? As of 2012, right? So this is time, 2013 is time 1, so time 0 is 2012. So we are at 2012, and value of the company in at the end of 2012 is this, right? And that's, I told you, value of the company they talk about here is generally in the stock market is called enterprise value, and which is basically market valuation or market value of the company, right? Which includes market value of debt, market value of the preferred stock, market value of the common stock. Now, this is what we don't know, but we know this value of the company, we know value of the debt, we know value of the preferred stock. So then this is this minus this plus this, right? This minus sum of these two. So that's what I did. Okay. Then this is what? This is the value of the common stock or common equity. In other words, aggregate value, not per share value, but aggregate, right? Total of all these, total of all these, total intrinsic value of all these, 300,000 shares. So then per share value will be this divided by this, right? So I got the per share value, right? So since the video isn't somehow the image on the video isn't really doing that, so I had to enter my own interpretation. Okay, let's continue. At the end of 2017, in other words, that's the value of all the free cash flows, 2018 and beyond, 2000 and forward, discounted back to the end of 2017. I guess this, okay, I can skip this part. So that's 10.3 million. Now, since this is 2007 free cash flow model in the common equity, okay, it's an aggregated value. That's why the F column. Okay, so this is it. I've been just the PowerPoint slide. So look, once again, the free cash flows. I turned them into present values, right? Well, again, this column seems like a duplicate, but it's not a duplicate. It's a duplicate, but just because of this. In 2017, that's not the only cash flow. 2017, there was okay, so that I already, so I'll skip that part. Since when have we used discounted cash flow model? When them out? When was it first developed? But the question is, when did called discounted cash flow model? I mean, specifically for the stock valuation model is called discounted cash flow model. I mean, specifically for stock, it's dividend discount model. But the question is, when did discounted cash flow model when them out? When was it first developed, and when? Since when have we used discounted cash flow model? Of course, it couldn't have been from ancient Greece or medieval time, because
stock, although there was stock market in Renaissance period, right, 19th century, 16th century. But in those days, there was no exact science for valuations. So all these models actually came out in the 1950s, right? And the birth of these discounted cash flow models was Gordon, right? I forgot his first name, not Robert Gordon. So then our question is, prior to 1950s, how did they value the stocks? In those days, prior to 1950s, they used, it wasn't really that mathematical, but they used something called, price earnings ratio multiple, price earnings multiple approach, right? So this isn't that much, but since we're out of time, we'll have to talk about this in next lecture, next class.
Okay, so finally, the last video in stock valuation, part 6.
In our last class, we completed the discussion about the free cash flow model, and as at the end, as a ending note, I said the models that you are now seeing, right, and the models that we are using in the present day, all those discounted cash flow models or dividend discount models were all developed in the 1950s. And then the question is now, so prior to 1950s, how did they price the stocks? How did they value the assets? So specifically, pricing the stocks in those days relied on something called price earnings multiple approach, right? Price earnings multiple. First of all, we all know what price earnings ratio is. Price earnings ratio is one of the market stock valuation ratios that have been used very widely and for a long time, even prior to 1950s, right? So that's how they could use price earnings multiple model. And two of the most commonly used valuation ratios are price earnings ratio and market price to book value ratio. And basically price earnings ratio is an indicator of how expensive, how costly, or how inexpensive the stock is for its earnings power. Whereas the market price to book value ratio is generally used as a measure of whether the market price is overvalued or undervalued, right, compared to the book value. So price earnings ratio is basically the ratio between the market price and earnings per share. Okay, so let me switch to the whiteboard, right? Okay, so what does P ratio mean? Price earnings ratio is literally market price. Price means market price, and earnings per share. And we know what earnings per share is. Earnings per share is basically EAT, right, or net profit, earnings after taxes, divided by number of shares. Okay, and then so if you think about it, if earnings, let's think about it. If the price is $200, right, market price $200, and the earnings per share is $2, right, the ratio will be 100, right? But what does this mean? You can tell easily that if this is the case, that means you have to pay $200 to buy the stock, but then the earnings per share at the end of the year is only $2. So what does this mean? Obviously, it's a very pricey stock, isn't it right? You would prefer, if possible, if it is possible, you would like, if price is like $200, wouldn't you want a stock that would pay like $50 earnings, right? If it is paying $50 earnings, what is the ratio? 4, right? When you pay $200 for the stock, and if the earnings per share is $50, then you would prefer, between these two stocks, which one would you prefer? Suppose this is company A, earnings per share of company A, price earnings ratio of company A, and price earnings ratio of company B. Which one would you prefer? I would prefer this, right? I would prefer definitely company B. right? So you can easily come to a conclusion that the lower the price earnings ratio, the better it is, right? Actually, there are two camps, right? There are two camps in academia that are kind of contradictory, or conflicting with each other. I mean, of course, that means the proponents of low price earnings ratio and the proponents of high price earnings ratio, right? Even in academia. Why? First of all, let me flip it around. For example, if you look at the structure of the price earnings ratio, you can tell that this is the output, right? Price is the not the output, that's the input, right? And then earnings per share, that's the output, isn't that right? Or yeah, because you have to put in $200 and then it puts out $50 or $2. That's the output. Then naturally, it seems more natural and it seems more intuitive when you look at actually if you're comparing input to output, right? I've been talking about this a lot. More logical and more natural way of looking at it is output to input ratio, and we've been talking about this a lot as well, right? In the risk and return, remember when we did mean variance ratio, right? And the reciprocal of mean variance ratio is called coefficient of variation, right? And I compared mean variance ratio as the U.S. gas mileage, because gas mileage is how many miles per gallon, right? So output to input ratio is a more natural way of measuring the productivity or efficiency, right? But I also said, in most other countries, they use the inverse gas mileage. In other words, they use input to output ratio. Why? If you use inverse gas mileage, what does that mean? Because it's like how many liters per 100 kilometers, right? The lower the number, the better it is, right? Because the lower the number, that means the automobile is more fuel efficient. So just like that, you can have both U.S. gas mileage, which is output to input ratio, or the rest of the world gas mileage, which is input to output ratio. So price earnings ratio is by structure, it's input to output. So if we flip it, then it's going to be what? The reciprocal of price earnings ratio is then earnings price ratio, right? Earnings price ratio, isn't it right? And so earnings price ratio is then exactly like U.S. gas mileage, right? It's like mean variance ratio. It's output to input. And if that is the case, then think about it. If we flip it around, company B would be $50 earnings, right? Company B's case, right? $50 earnings for $200 cost, right? Or input. So in this case, it's going to be 1/4 or 0.25, right? 0.25. And company A earnings price ratio of company A will be $2 over $4. So this is going to be 1/100, right? Which is just 1%, right? Or 0.01, right? 0.01. Now then, what can you tell? If we use earnings price ratio, then the higher the number, the better it is. Of course, U.S. gas mileage. Look at the gas mileage. The higher the number, the better it is. The higher the fuel economy, right? Now, but then the name actually, this can be called earnings price ratio, but there is another name. This is called commonly, more conventionally, it's called earnings yield. Okay, earnings yield. Okay, earnings yield is the name. Okay, now because earnings yield came up, right? Now let's think about it. There are this is called earnings yield, right? But then what should this be called? What is this called? That's called dividend yield, right? Dividend yield, right? It's basically, return measured by dividend. This is return measured by earnings per share, earnings, right? And then you know the difference between dividend and earnings per share. Dividend is only a fraction of earnings per share that is paid out to the investors, right? And now as we into this, annual coupon payment divided by price, right? Of course, this is bond, right? Because we're talking about coupon divided by the bond price. What's that called? This is called earnings yield. This is called dividend yield. And this is called what? Right? Called earnings yield, dividend yield, right? It's hard to write it, but earnings yield, dividend yield. And then what is this called? Annual coupon over price of the bond. You forgot already? That's called current yield. Remember that? Current yield, right? Current yield, right? Now, interesting thing is, now let's get back to the discussion of, price earnings ratio. So let me, everyone is okay with this. Let me clear that. And so as I said, although there's earnings yield, earnings price ratio, but it's more conventional to use price earnings ratio, right? And then, as I said, in academia there are two camps. The proponents of low price earnings ratio, which makes more sense, I mean more intuitive, and but there's another. The other camp prefers high price earnings ratio, and why? I mean, it defies all common sense and logic. Why would you want high price earnings ratio? I mean, if it is only price is $200, but the if it gives only like $10 earnings, then isn't such a stock overvalued, right? It looks more like it looks overvalued. It's quite pricey. In other words, it looks like there's a lot of bubble. I mean, for the earnings power, if the price is that high, it looks like there's a lot of bubble built into the price, right? But then in academia they call it. Now think about it. What they're saying is even if the earnings per share is so little, the fact that the price is still supported, that high price of $200 is still supported, simply means that there is the demand. I mean, if what supports the high price is a strong demand, isn't it right? Strong demand. And if there's strong demand is there's a good reason for that strong demand. That's what they are basically arguing. And that strong demand is due to what? Well, it's called there is strong demand still supporting that high price. It's all because of present value of growth opportunity. Present value of growth opportunity. And what that means is, although this company is making so much profit right now, but it's got a huge growth potential, right? That's everyday's language, growth potential, right? Huge growth potential. So huge growth potential is supporting this high stock price, and because of that, the present value, the price is basically reflecting the present value of growth opportunity, right? It's not bubble, it's present value of growth opportunity. That's what they say. But then our next question is, how do you know there is, a present value of growth opportunity is simply the mathematically, actually, it's the difference between in the valuation model, it's the difference between not paying any dividend, not having any retained earnings, and think about it. What is the earnings per share for? The earnings per share is actually if the company doesn't pay out any dividend, right? The entire earnings after taxes, is all reinvested, right? Makes sense. So a company that's not paying out any dividend, although it has huge EAT, what do they do with that huge EAT? Basically, it's supposed to be plowed back into the company, meaning it gets reinvested for the growth of the company, right? And the between a company that pays out their entire earnings as dividend, right? Think about it, earnings belong to the owners of the company, right?
shareholders. So although the company normally don't pay out the earnings, right? They reinvest it. But if the company pays out all of those earnings, then what does that mean? The company has no growth potential at all, right? So between a company that has zero growth potential, a company with zero growth potential, or a company that has zero whose present value of growth opportunity is zero, which pays out all of its earnings, and the company that doesn't pay out any of its earnings but retains all of its earnings and reinvests it, the difference between those two companies, right? I mean, the price of the company that pays out everything, pays out all the earnings to the shareholders. That company has zero growth potential, so its future value, I mean, price at time t plus 1, what's it going to be? Price at time t plus 1 will be equal to price at time t, right? Because there's no growth potential. But if the company retains all the earnings, right, and reinvests, price at time t plus 1 will be greater than price at time t. Make sense? So that is basically the present value of growth opportunity. Difference between the difference between price at time t plus 1 of a company that pays out everything, all the earnings to the shareholders, and the company B, price at time t plus 1 of the company B that doesn't pay out anything but retains all the earnings. Then company B has a high growth potential, and the difference between these two companies, right? Let's say their price at time t was the same and earnings was the same, right? The difference between the two is exactly the present value of the growth opportunity, right? So what they are saying is, the proponents of high price earnings ratio camp, what they are arguing is that the this high price is supported because of the strong demand, and strong demand pushes up the price, right? So price will be over exaggerated for its actual earnings, and it's only natural. And even if, I mean, if the price is even that exaggerated, but still investors are buying that stock because they believe in present value of growth opportunity. That's their argument. But then still, the question doesn't leave me. So what is the question? The question is, okay, how do you know? I mean, although it's nice to call it present value of growth potential, but in other words, that's growth potential, right? Present value of growth opportunity. In other words, it's growth potential. What is potential? Potential is nothing but, I mean, if it realizes, right? In other words, if the growth realizes, and actually, growth comes into fruition, right? Actually, it bears fruit, and then that's good, right? And there's a solid basis behind that belief that this company has high growth potential. But what if it flops? Actually, there are many, like pharmaceutical companies. There are many names that are coming up, during the period of, during this time, of COVID-19. Companies that are developing vaccine, Gilead, Madonna, or there are several companies whose names really emerged because of their R&D in COVID-19 vaccine, and their prices went up a lot. But then think about it: if their vaccine gets approved by FDA or CDC, then the growth potential will come true, right? That it will be fulfilled, it will be realized. But what if even after very extensive research for 1 year, 1.5 years, their product doesn't meet the criteria, and then they don't get approved by FDA or CDC, then what happens? That growth potential turns into nothing. It's just everything that was feeding into the stock price was nothing but bubble, right? So in other words, there are two possibilities, take off, success, right, and take off, right? The new product actually becomes very successful and it takes off, or flop, right? So in other words, we don't know if it is, I mean, this present value of growth opportunity is, how solid it is, how solid it may be, and actually, what's supporting the high price earnings ratio? Maybe nothing but bubble. Of course, we can try to find probabilities and calculate probabilities and assign the probabilities there. For example, if the probabilities of takeoff success is higher, like 80%, flop 20%, expected the expected value would be still positive, right? Then low price earnings ratio is relatively quite solid, right? We understand why low price earnings ratio is preferred, because of solid evidence. It was solid evidence that the earnings power is great for its price. But then the question is, and also the critique from the high price earnings ratio camp, the critique, right, is that the look, if there is if the price earnings ratio is low, that means for the earnings power the stock is undervalued, right? If it gives you so much earnings per share, then shouldn't the price jump? Shouldn't the price go up? Why? Everybody would want that stock. So the demand, there will be huge demand, and strong demand will push up the price. Yeah, that is quite valid criticism, right? Because valid criticism, because if the so it's a question of how long does the window of opportunity remain open, right? If you've been hunting for these low price earnings ratio stocks, and you found it, and if you could find it, right, through research, right, of course it's very labor it would be labor intensive, because you have to go through a lot of stocks, right? It's not like you have to first shortlist it out of candidates. Let's say S&P 5, anything in S&P 500 has been well researched, right? It would be difficult to have, but also relatively less known stocks in the Russell 4000 or so. And then if you identify, you have to shortlist a few of them. You go through like thousands of stocks and shortlist down to like something like 100, and then stacked up in the order of earnings power, price earnings ratio, and go let's say shortlist it to the finalists of 10. But then when you found 10 of them, the best performers, right, the lowest price earnings ratio, and by the time you put money in them, others would have also discovered those 10 stocks, and they also put money, pour their money into those stocks. Then sooner or later, what's going to happen? The price will go up, and as the price goes up, then the window closes, right? So the question is how fast you discover these stocks before anybody else, before the window is while the window is still open, and you put the money into that, and the late arrivals will, for the late arrivals, window will close, the entrance will be very small, and then when everybody puts their money in, price goes up, and if you're the first comer, you make money, right? But once again, the critique from the high price earnings ratio camp is that saying that these days, with a lot of information, a lot of effective way of collecting information, most likely the window wouldn't remain open for a long time, and that is quite plausible. That's so they are both they have critiqued each other. Both camps have critiqued each other, and but so far empirical results empirical results so the low price earnings ratio speaks for itself through empirical results, because the champion or the figurehead of this camp, low price earnings camp, is none other than Warren Buffett, right? Warren Buffett's strategy is basically identifying the undervalued stock, low price earnings ratio stock, and invest in it. So, and also there's a supplemental method of verifying whether this high price earnings ratio is solid or nothing but bubble, and that which is that verification method is called price earnings growth ratio. Okay, so I'm going to come back to price earnings growth. Okay, let me explain quickly. We have a little time, but so price earnings growth ratio is what? Price earnings growth ratio is basically price earnings ratio over earnings growth ratio, right? And if this number is close to 1, if this ratio is close to 1, then that high price earnings ratio is justified. So what does that mean? Suppose price earnings ratio is 100, right? Price earnings ratio is 100. So price earnings ratio of 100 is very expensive stock. Why? If you pay $100 for that stock, get in earnings is only $1, right? That's what price earnings ratio, P ratio of 100 means. If it is $200 stock, the earnings per share is only like $2. $1,000 stock, a $500 stock, price earnings ratio of 100, right? For a $1,000 stock, the earnings per share is $10, right? That's what it means. But if this high price earnings ratio for the stock with this high price earnings ratio, if the earnings growth rate, suppose the earnings growth rate is 100%, what does that mean? If annual earnings growth is 100%, that means this company's profit is doubling every year. Makes sense? If the company's profit is doubling every year, what would be the demand for such a company? It goes without saying the demand would be very, very high, right? I would definitely want to put my money into a company whose earnings growth rate is 100% a year, right? And then a high price earnings ratio of 100 is justified, it's well supported. I mean, the number may not be exactly, and ignore this percentage, right? Because when you take this ratio for this to become 1, you'll have to ignore that percentage, right? Because 100% is only 1, right? So if this ratio is, but it may not be exactly 1, but if it is close to 1, if it is roughly, right, close to 1, that means that high price earnings ratio is well justified. Okay, all righty. So then that explains what P ratio and what P ratio does to the confirm whether high price earnings ratio is validated or not. Now, so let me erase. So back to the price earnings multiple. So price earnings. The price earnings multiple technique is basically a stock valuation pricing technique, and then what it is telling you is that the price of the stock is price earnings ratio times earnings per share. Okay, earnings per share. But then some of you may have already discovered something weird about this. Why? Isn't that like isn't it a tautology? Tautology is a statement that is always true because it's referring back to itself. Why? Look, what is this? Price earnings ratio is basically market price over earnings per share, right? So then if you multiply that by earnings per share, what happens? Earnings per share cancels out with earnings per share, both gets canceled out. It cancels out itself, right? Then by definition, what does that mean? And price is price. Market price is, but what this means is this is the market price, right? Do we want to know the market price? I mean, are we calculating the market price? No, I've been telling you, market price is not something you calculate. Market price is the data in the market. I mean, the market's trading data is there. You can always retrieve that. You can look up the market trading data. Today's end of today, right? Closing at the end of the today's trading, the closing price of the today's day's trading is today's price. Or at any point, during the day, at 2 o'clock, you check the price, and the most recent trading, most recent price is there. So it's not the market price that we are trying to solve for. It's what we are trying to solve for is the intrinsic value. Remember that intrinsic value, right? So then if this formula, this price earnings ratio, is like a nonsense, because it looks like a nonsense because earnings per share cancels out each other, and then you're left with the market price, then that simply means price is market price. I mean, what's the point then? You didn't get the intrinsic value, right? So actually, this is a misunderstanding. Why? So what they are trying to find is, okay, let's call that stock price of company X. Okay, stock price of company X is the price earnings ratio of the industry price earnings ratio. In other words, industry average, right? Industry average price earnings ratio of industry times earnings per share of company X, right? So think about it. This earnings per share and this earnings per share won't cancel out because they are not the same earnings. This is the average earnings per share for the industry. I mean, this ratio is basically the ratio of the industry. So if you think about it, the reasoning behind this formula is that so company X made like $50, $20, let's say $20 earnings per share, right? The most recent earnings per share of company X was $20. Market price would be something, $100 or whatever. And but through the on average, this industry's price earnings ratio is 15, right? On average, price earnings ratio of this industry is 15. then based on or compared to the or extrapolating on the from the industry average price earnings ratio, what would be the rationally expected, right? Most reasonably, rather than rational, most reasonably expected price from the through the lens of this industry. Through the lens of this industry, what would be the most likely price, right? Right? Considering industry average price earnings ratio of 15, what would be the most likeliest price? And the most likeliest price, or most likely or likeliest price, would be then $20 times 15, and it's going to be $300. Okay, and that is the like fair value, the lens of the industry, right? And if the market price is let's say 310, okay, what can you say about this company or about this stock? You can say this stock is overvalued. Why? This is the most reasonably inferred price through the lens of the industry average price earnings ratio, right? But the market is pricing it higher than its fair value. So the stock is, this is the market price, this is the price that it should be. So it is overvalued. Or you can say, what if it is 290? Of course you can say, then the stock is undervalued, okay? Now, then the question is, this is how they did it prior to 1950s, okay? Although this is an old, technique, right? They still use this widely because, for people who didn't have a formal training in finance, right? They don't know anything about discounted cash flow model. They don't know anything about the risk, right? They don't know anything about, a statistical method of, measuring risk, mean variance ratio. They don't know anything about that, right? But price earnings ratio is relatively easier to understand. And without too much, without that, too much training, still they can understand the rationale behind price earnings ratio, right? But then the downside of this price earnings multiple method is that the it's not accurate. It's not exact science, right? Why? It's just a rule of thumb, because if you're valuing the stock through the lens of the industry, average industry, I mean, within the same industry, there are so many different firms. Although they're in industry, each firm would have different risks, right? So this company X would have a different risk from company Y, or company Z, company A, company. So there is nothing in this model that would make adjustment for the risk that specific risk that this company X is faced with, right? Get that? So it's not very modern, right? Technique. One, the first downside. Two, most critically, right? It's lacking risk adjustment, right? It's not risk adjusted. So which would then result in inaccuracy, right? Imprecision, right? So it's not exact science. And that's the downside of price earnings multiple approach, right? So okay, so this wraps up everything about the.
All right, so we're done. We're done with stock valuation, right? Stock valuation models. So our next topic will be topic 7. And this topic 7 is just became visible today. So this is continuation of risk and return part 1. This is part 2. So we have 3 videos here. Of course, we're going to do this over the remaining part of the, not today, but today we're going to get started on this. But we have Monday and Tuesday. But you can go ahead and watch these videos, and available after August 19th. I'll make it available already. This one. in the world already today. For others, um, okay, I'll make. So let's take it. Time is 7:12. I think this is a good time to take a break. So let's take a 10-minute break and reconvene at like 7:22, 23. Okay. All right. Any questions so far? Any questions? Any questions? Any questions? Okay. All righty. So let's take let's take a 10-minute break. Okay. Let's take a 10-minute.
All right, we're back. We're back. I see Wing King has raised hand. Wing King, do you have a question, Wing? Hello? Okay, looks like you lowered the hand.
Yes,
All
I
right.
do have questions. I'm sorry, I asked you 2 times already today, so bear with me. I just have one simple question. All right,
Uh-huh.
one is where did you find the average PE industry? You mentioned you used the number 15 in the example, but you never mention about where do you find the average industry?
Industry P ratio, industry average P ratio. There are several sources, right? One, uh, I uh, I wrote up the, I made a list of those sources at some point and I posted it somewhere, but something like, bankrates.com, or, you can also go to Yahoo Finance and go to company profile, and you can find, some ratios, there. For example, let me, IBM is not here, but you can go to Yahoo Finance and just, type in, let's say, IBM, because this is not, yeah. Uh-oh, why isn't it working? Okay, IBM. Okay, and this is, basically, IBM's, price movements. That's not what we are interested in. Still, look at the market's consensus about, this is short term it's bearish, but long term bullish. And I want to know. Okay, so this is chart. So let me go back to. Look it up from here. And then if you go to financials, these are generally just the income statement, balance sheet and things like that. They are showing the income statement. So we used to have, they used to have, not in profile. They used to have on valuation measure, right? Price to book ratio, trailing P, generally trailing P, right? P ratio, that's like trailing 12 months. So earnings per share, what this is, P ratio based on, current price over average of the trailing, average earnings of the trailing 12 months, right? That's usually what they use. And the industry, they used to have industry data here as well. But if it is not, you can always find, you can always look up on Google. You can Google up, right? Or again, industry ratios. Okay. You can always look up industry ratio, right?
listed companies, right? Industry. So do a little research, okay? Do a little research. You can always do a little research, okay? All right?
Okay. Okay. Got it. Got it. Second
Mm-hmm.
question, also my last. Where I mean the EPS. Even though, and you mentioned that some companies decide to reinvest all their earnings into the company and not distribute any dividend to shareholders. Okay, if even in that case, can we find the EPS of a company on the book?
Can we find what?
The EPS, the earnings per share on the
Earnings
book.
per share.
Let's say just Yahoo.
Oh yeah, yeah, yeah. Yes, of course. Yes, of course. Earnings per look. These companies may not want to pay out dividends. So, but think about it. If they don't pay out dividends, and where does the dividend come out of? Where does the dividend come from? Dividend comes out of the profit. Profit is EAT, right? Profit is EAT. So EAT and earnings per share is simply EAT divided by number of shares. So all those financial data I just showed you from Yahoo Finance. You can also they may have earnings per share readily available here, or um, you see they don't have they have EBIT, but they don't have EAT. But look, um, financials. It would be usually financials, right? Uh, um, these are like trailing 3 months, right? Uh, look, net income, right? Net income coming from continuing. Uh, yeah, net income from continuing operations, right? These net incomes, right? That's EAT. And if you divide it by number of shares outstanding, right? That was income statement, balance sheet. It will show you how many not shares issued, right? You divide EAT or net profit by this, that gives you earnings per share. It's only a matter of finding their fundamental data. In other words, their fundamentals, data about their fundamentals. In other words, their uh, uh, the the word is escaping me, but their uh, income statement, balance sheet, and those data of any publicly traded companies are available. It's open. It's open to everybody because it's publicly traded, right?
Got it. Thank you. Appreciate that very much.
Mm-hmm. All righty. So let's continue, right? This is the first video, and these topic 7 videos will become available from 12 midnight tonight. Okay.
And we are continuing today to discuss the risk and return. Of course, remember, this is the third video in risk and return in this topic, because at the end of the second video, I said briefly that we will be briefly leaving this topic to go into the stock valuation, and after we're going to come back to this topic after the stock valuation. So there were 6 topics, 6 videos in the stock valuation. That was a long topic, right? And then there's going to be 2 more videos, hopefully, just 2 more videos in this topic of risk and return. We already covered a lot about the risk in our last videos, 2 videos, but the risk It was mainly about the mathematical and statistical side of the risk. In other words, how to measure risk and how we can use return risk ratio to pick stocks, right? To pick an asset, right? To put.
Okay, I don't know why this screen is flickering, but it was already like that when I recorded it. I mean, when I recorded it, it was fine, but the output, right? The when I played the video, it came out like this. So this is basically the PowerPoint I already have there. So you can refer to the PowerPoint that
Very bluntly. Now, at this point, we would like to continue to actually to go to the source of the risk, right? Of course, we define risk as the variance around the expected mean, right? But other than that, that's from the estimation perspective. But the question was, the questions about the sources of the risk wasn't quite answered, right? In case of remember, when we first started talking about the bond and risk of the bond, right? It was actually to discuss the risk premium, right? Remember, default risk. Of course, the greatest risk is the default risk, and liquidity and maturity and inflation risk. All those things were discussed in terms of bond and the cost of capital, cost of debt, right? But first, and then in case of stock, what would be the source? What would be the sources of risk? Just like as we defined in the bond. Pretty much a lot would be common because when it comes to basically financial assets, making an investment in financial assets, those things would. The greatest risk is default risk. Of course, in case of stock, it's not called default. I mean, you lose your money as an owner, right? If the business fails, you lose your money as an owner. But it's not like the borrower defaulting, right? In other words, you're not a lender, right? So losing your money is due to loss of money, not default of a debtor, right? So anyway, we need to just start with the definition of defining what risk aversion is. It's not the crucial thing at this point, but we all understand to some extent. Some people are more risk averse, and some people are. You don't want to, and most of us, right? It's a human nature to stay away from risk, or even if it is inevitable, right? Even if of course to invest, you have to take the risk. Without taking the risk, there's no return. But then you would like to minimize the risk. Right? That is just a rational human being, right? Rationality is telling you to avoid, if possible, to avoid it at all. But if it is inevitable, to minimize it, right? So it looks like this. Then think about it. We have two investments, and it's quite obvious. What does this show? There are two stocks, right? Or one both with the expected return, both projects or both investments both stocks have the same expected return, and then this blue stock has smaller variance, whereas the red stock has wider variance. Then which one is preferred? Of course, mean variance ratio. Which one would have a better mean variance ratio or higher mean variance ratio? Of course, the blue stock, right? The same mean smaller variance, you would have definitely a better mean variance. So higher mean variance ratio or higher return risk ratio, right? So blue stock is preferred, right? And we talked about this in the in the previous lecture. And there are two ways you can measure the input-output ratio. This is an output-input ratio, but you can use the inverse gas mileage, right? Remember that. But anyway, if you use reciprocal of the this invariance ratio, then it's what a coefficient of variation, right? That was in the second quiz, right? So and then next question, right? It actually over time that variance would look like this. remember, this picture is completely disregarding the flow of time. I mean, remember Apple's data we downloaded? It was over the last 5 years. But then if you put it without the time division, just like as if they are all coming from the same month, right? And you distribute it on a plane, it would look like this. But if you distribute it along the timeline, right, it would more look like this. It would look more like this, right, as time goes on, right? And obviously, when the business cycle, I mean, this side of the picture, this range of the graph is representing the upcycle, when the business cycle is good, right? When the economy is good, most businesses are in upcycle. So, as I said, most businesses are cyclical, so they would be, on upcycle, right? And this would be, when the economy is in down cycle. And stock B would look like this, right? Stock A would look like this, right? Yeah. And what if it is easy to pick, it's easy to pick a stock if they have the same mean, because anything that has a smaller variance is preferred as long as the expected return is the same. But if they have different means, right, or different expected returns, it says neither preferred with certainty. No, you can't tell, as long as the numbers are given, as long as we can tell with certainty, as long as we know what is the mean, right, and what is the variance or standard deviation, we can take, mean variance ratio, and whichever comes up with, higher mean variance ratio, that will be preferred, right? It just says neither preferred because with certainty, because we don't have any numbers, right? Next. Which one is, I mean, some people might say, stock market is, playing stock is like, gambling. To some extent, if you don't use any, I mean, if you have no training in finance, right, it would be like a gambling, right? But at least, you have, if you have training in economics and finance, it's not gambling. Now, what's the difference between gambling and investing? In gambling, right? I mean, in investing, the expected return is positive, always positive. Why? You wouldn't invest in anything, any stock or any asset that has negative mean value or zero mean value. Isn't that right? You wouldn't put your money into anything that has negative mean return, negative average return, right? You won't put in other words, negative expected return. You won't put your money in any stock that would have negative or zero expected return, right? Although the outcomes may be negative, right? Because of the variance, sometimes you get negative return, but most likely you will get a positive return around the mean. But gambling, in case of gambling, the mean return is always negative. What kind of gambling can you have, a positive expected return? There's no such thing. I mean, you go to a casino, right? I mean, why would casino lose money to you, right? They won't have that kind. I mean, if casino loses money to you, and if the expected payoff to you is always positive, and expected payoff to the casino is negative, they won't be in that business. Make sense? It's only because their expected payoff is a positive that they are in the business. And some people, might win money in the casinos, but then think about it. If someone hit a jackpot in the slot machine, so he got, $500. But until he got $500, how many bundles of $500 do you think he has lost? He must have lost like 10 times, right? Like $5,000 he must have lost, right, in the past. And then only once, the odds are like 10 to 1. He lost 10 times and just won once. And then after this, he may lose again for another 10 rounds, right? So in gambling, the maximum you can lose is 100%. You lose all your per each. I mean, you're playing the slot machine with $500 every time. Lose $500. That's 100% loss. You come back with another $500. You lose again, another 100% loss. And of course, if you win, the positive side is endless, right? I mean, you could, of course, in investing, if you win, I mean, for example, if you had bought Apple in 1981, and that's what I always regret. I was in '81. I was a junior. In 1981, I was a sophomore to junior. in college, and had I just known at the time about the company Apple, if there's time machine, I would like to go back to those days and put all my money into Apple. And over 40 years, it even more than grew 10,000 times. Whatever whatever little money I had at the time, I would have. But of course, the probability would be very low. But not especially if you're thinking of only 1 year timeline. Of course, that may not be achieved. But if I kept my money in Apple for 40 years, right? And both investing and gambling, right? In gambling, you lose for sure. There's a very high probability. This is like a good probability, right? Look at the tail. It's not like very thin tail, very big tail, right? Thick tail. Of course, investing, of course, you can lose 100%, right? But the tail gets thinner, right? That means the probability density is very low, right? Very thin. Now, probability density is very thin, right? The thicker this area, that's probability density is very high. Now, so it's just these are the examples of mean variance ratio. We're not gonna. So now we need to then think about the sources of risk. There are two sources of risk, okay, to stock. One is systematic or systemic, and unsystematic or unsystemic risk. Actually, the words systemic and systematic are different in semantics because systemic means it's something inherent to a system, right? Systemic failure means the system already has built-in error, right? It's an error inherent to the system, so this will lead to a failure, right? But systematic means something methodical. I mean, if you're doing something in a systematic way, that means you have a system. You do it in a methodical way, using that by the system, right? So although the semantics would be different, but actually they are used interchangeably in our context, right? When we are talking about the risk, they're used interchangeably, although they mean two different things. But there is also, I would say, it started out as systemic risk because the risk is coming from the system they are talking about is the economic system, macroeconomic system, okay, and the financial market, right? So it was originally systemic, but then there is also a systematic element to this. So hence, it came to be called also systematic risk, okay? So please bear with me. I understand. There are two things. You might be wondering. Oh, so where is that file? Where is this slide? This slide. Let me. This is a slide titled "Risk and Return." Right. That would be like it's posted there, I believe. Let me check. Where in that? Where in the Blackboard it is, Laura. Let me see. Also, let me see. So it's there. The file is there, right? Yeah, this is the file there, risk and return. I posted it. If you go into the lecture notes folder, temporary folder, if you go into the temporary folder, there, risk and return. It's not. Let me see.
Well, it's actually, this file is the same file you would find in topic 5. Okay? It's in topic 5.
And there might be a flicker. I don't know why. This is probably if you don't see the flicker on the screen, that's fine. And it may be kind of bothering to some people. Now, so as I said, systematic risk refers to the risk coming from the macroeconomic system, right? And financial market, right? Financial market is directly affected by the events in the macroeconomic system, and it's risk is basically risk is the variation, right? Variation caused by things that influence all stocks, political news, inflation, interest rates, most of all interest rates. It's macroeconomic, right? And then unsystemic or unsystematic risk is business-specific risk. In other words, it's not coming from the macroeconomy or the financial market. It's a risk associated with the particular specific nature of the business and the industry, right? Something like labor unrest, weather, death of key executives, and things like that. Whether hotel, travel, and tourism will be affected a lot by weather or pandemic and things like that. Labor unrest. So it can be summarized like this: the total risk, right, comes from systematic and unsystematic risk, right? Systematic risk comes from these 5 elements. First one is financial market risk, interest rate risk, reinvestment rate risk, purchasing power risk, and exchange rate risk. Right? So think about it. This is all coming from the macroeconomy. First of all, interest rate changes, right? It's macroeconomic factor. With the interest rate change, reinvestment rate would be affected as well, right? And we talked about interest rate risk and reinvestment rate risk already when we did, a bond. And purchasing power risk is what? Inflation, isn't it right? Inflation affects purchasing power negatively, right? Adversely, right? Or inversely, right? Inflation goes up, purchasing power goes down, right? And vice versa. Exchange rate risk, right? Exchange rate. Now, exchange rate affects a lot the macroeconomy. I mean, there are 2 aspects to this. I mean, I don't have time to give you the examples of each, but one example is quite obvious. Any country that is exporting mainly whose economy depends on economy will be affected adversely when exchange rate goes up. I mean, what does the exchange rate go? If the exchange rate is low, right? What does that mean? If exchange rate is low, what does that mean? I mean, any country that is heavily dependent on export, when exchange rate goes down, that's not a good news. You might think when exchange rate goes, oh yeah, because you say, you might think exchange rate goes down, and doesn't that anything going down doesn't sound good, right? So if exchange rate goes down, isn't that a bad thing? No, actually, it's a bad thing for the exporting economy, but not because of the reason you might think. First of all, what does that mean? Low exchange rate for example, between US dollar and euro. Let's say the current. Let me use the whiteboard. Stop sharing, and let me use the whiteboard. Let me go to the whiteboard. Let's call this exchange rate. That means exchange rate, and exchange rate between US dollar and euro. Okay. And exchange rate is usually defined as U.S. The domestic currency price over or per foreign currency price. So let's say 1 euro is $1.50, in US dollars, right? That means what? You have to buy 1 euro, you have to pay $1 US, right? So that makes the exchange rate 1.5, right? Then you might think, okay, so what if exchange rate goes up? What if this goes up to 2? What does this mean? Exchange rate went up, right? And as exchange rate goes up, what does that mean? Did US dollar get stronger or did it get weaker? If you say stronger, you're just saying anything that just comes out of your mouth, right? And if you have, if you're international students or if you have been traveling overseas a lot, you would easily understand this means dollar got cheaper, right? Isn't that right? That means dollar got weaker. Isn't that right? Why? Because previously with only 1 euro, you could buy 1.5 US dollars, right? But now with just 1 euro, you can buy 2 US dollars. Then what happens to the US dollar? Dollar got cheaper or dollar got weaker. Make sense? Right? You get it? So, so when exchange rate goes up, that is the depreciation of the currency, right? Depreciation of dollar, and vice versa. When exchange rate goes down, then dollar got stronger. For example, this went down to 1. What does that mean? There are 2 things that can happen. It can go up or go down. That means now it is $1 per 1 euro. What does that mean? Before, to buy to buy €1, US citizens had to pay $1.50 to buy €1. But now they can pay just $1 to buy €1. So which currency got stronger? Dollar got stronger, euro got weaker. Makes sense? Then this is the appreciation when exchange rate goes up, right? That's the depreciation of dollar. When exchange rate goes down, that's the appreciation of dollar, right? Makes sense? Then think about it. If your economy is heavily dependent on export, you're mainly exporting, and countries like South Korea, they all depend on a lot on export, and they export a lot of things, high tech, from high tech to low tech. High tech, of course, mobile phones, automobiles, all electronics, memory chips, China is chasing right behind, right behind. You might think China is, ahead of South Korea. No, not at all. So, China is just large, very big economy, huge country with huge population, 1.6 billion. South Korea is only like 50 million. It's not even right. 10% of 1.4 billion is 140 million. Right? 100. So South Korea is not even 5% of in terms of population, right? Almost not even 5%, like 3% of the population of China. But the size of the economy, if you compare, South Korea is like $1.5 trillion, 1.5 trillion. China is about 12 trillion, somewhere around 12 trillion. So South.
Yeah, that was, take it with some grain of salt. That was as of 2018. The data was as of 2018. So obviously, I gave you updated, GDP data early on, right? So take it with some grain of salt.
South Korea is almost like 10% of in terms of size of economy. So then think about it. You divide, 1.5 trillion by 50 million people. What does that make? At least, per capita, right? South Koreans are making $30,000, right? If you simply, divide 1.5 trillion by 50 per capita, right? Including even baby, 99-year-old person, or right? By the whole population divided by whole per capita. Their annual per capita income is 30,000. Of course, it's because babies don't make money, right? Babies don't work, right? Actually, there are true per income earner, right? Annual income per worker would be probably about 50K, almost close to the U.S. But China, think about it: $12 trillion divided by make it even $12 trillion divided by 1.6 billion. What does it, So anyway, but the reason South Korea is that much ahead is because the technology-wise, South Korea is still ahead, right? Of course, I'm not, making little of, potential of China, but a lot of, and you understand, China as an exporting economy. True, China is pretty much, globally, because it's so big, and as they say, factory of the world, factory for the world. So it's churning out a lot of goods, cheap to everything, cheap to expensive, low grade to high grade, but mostly it's still a lot of things that are globally exported or relatively on the low grade side. But one thing, think about it. With such a huge population, eventually China doesn't have to depend on the world market. They will, even just by domestic economy, right? They will have enough demand to sustain their own. It's not at that point yet, but if per capita income goes up, then they don't have to necessarily depend on foreign trade, international trade. But a country like South Korea, with a population less than 1 billion, right? And just half that, currently 500 million, right? 50 million, right? They will have to rely on.
50 million is not even 500 million, right? 500 million is 500 million. So that I was kind of carried away.
international trade, mostly export, because their domestic market size of the domestic market alone is not enough to consume everything that they produce, right? And their production capacity is way more than just what their domestic demand can handle, right? And for an economy that is heavily dependent on the exchange rate, when the exchange rate goes down, is this a good news or bad news? If exchange rate goes down, this is a bad news. Why? Think about it. Exchange rate is defined as domestic currency price over foreign currency price. So put South Korean currency here. South Korean currency is Korean won, or just like. Okay, currently about exchange rate is of South Korea is currently about like 1,021. This is like $1.02. It's not like 1,001 sounds like a big thing, but they don't have any cents. So this is like 2 cents, right? $1.02, and per US dollar, right? I mean, even if it is something like this, 1,201, that's like $1.20. It's like $1.20. And suppose this exchange rate goes down, that means what? Suppose 1,000 to $1, it's just like $1 to dollar, or even lower, like 801 to US dollar. That means South Korean currency appreciated. And if South Korean currency has appreciated, what does that mean? All exported goods are becoming more expensive to the US consumers. And since international trade is carried out in dollars, right? It's the called key currency, right? US dollar, European euro, Japanese yen, Swiss franc, British pounds. These are 5 key currencies of the world, and all international trades are carried out only in these 5 key currencies. So that means if one exchange rate goes down and it goes Korean won appreciates, this will mean a disaster to the Korean economy because their export becomes more expensive to the rest of the world, right? Their export suffers, then the GDP goes down, right? From $1.5 trillion a year, now it's going to go back to 1.3, 1.2. Then the per capita income will suffer a lot. So strong currency is not a good news for the economy, right? A weaker currency, especially for a exporting economy, weaker currency is a good. But I got a lot to talk about this, but I cannot spend a lot of too much time on this. So we'll just leave it at that. So exchange rate will affect the economy. That's that goes without saying. Companies that you can easily understand that companies that are heavily dependent on exporting, companies that are exporting a lot, dependent mainly on exporting, right? International trade, their stock price will suffer a lot, and these are the factors that are coming from the macroeconomic system. Make sense? Now let me switch back to from the economy, and that's why it's called systematic risk. And unsystematic risk comes from two things. First, financial risk. Financial risk is, you might wonder, aren't we? Anyway, we're talking about the financial market. I mean, isn't everything about the financial risk? I mean, all the risks are basically financial risk. No, they wouldn't use the word redundantly, right? There's not, especially in disciplines like academic disciplines like economics, finance, science, math, statistics. One thing they hate the most is the redundancy, right? You don't use the same word twice, or you don't use the same, everything. Math is very terse language, isn't it, right? In math, you don't use the same thing. I mean, one variable is not defined differently twice, right? So obviously, this doesn't mean, it's not that fluffy, okay? It's not like, everything is about finance. So no, it's not that fudgy, fluffy, frill, right? There's nothing like fuzzy, fluffy frill in economics, finance, science, math. What this means is, then what does this mean? Actually, it means leverage. What does leverage mean? It's the use of debt. It's the use of debt, right? So what it means is, you might also say, don't all the companies use some debt at some point, and to some degree, to some extent, anyway, they all use debt. Yes, true. All companies use leverage or debt to some extent. but the degree of leverage differs from one industry to another. It's not like company by company. It's not by business, but there are industries that are more prone to use more debt. Okay, and there are industries that are less prone to use debt. So what are those? And think about it. If a particular industry is more prone to use more debt, doesn't that mean that particular industry is more likely to be under heavy burden of debt servicing? Right? Debt servicing means paying interest for the debt. Yeah. Remember what capital structure is? If the capital structure is 30% equity and 70% debt, what does that mean? This company is very, very heavily leveraged, and then whatever they make, their operating profit or EBIT, right, earnings before interest and tax, EBIT, or operating income or operating profit. From EBIT, you have to pay out interest expenses, isn't that right? So you pay out interest expense, then what does it become? EBT, earnings before taxes, right? Now think about it. The higher the debt ratio, the interest expense would snowball, be huge. It will grow. The interest expense would snowball like huge snowball, right? Then all of the EBIT will be used to pay interest. Makes sense? Then what will you have left? You will have nothing left. Even for EBT 0, then you don't pay any taxes. You can't say, hooray, we don't pay any taxes, right? You don't pay any taxes because your profit is 0, and then you have nothing left. No EAT, no earnings after taxes, right? It could be even negative. Now, so that is the financial risk. The higher the leverage, there's more financial risk. The higher the financial risk, what does that mean? It's debt. So the higher the financial risk, the higher the default risk, right? Makes sense? Isn't it obvious? The higher the financial risk, the higher the default risk, right? That's about default risk. And I said it's not by company, but it's industry by industry. Why? Let's compare two industries. Airlines and restaurants. Airlines and restaurants. These two industries have something in common, but also something drastically different. First of all, they are both, they can fall into travel and tourism. Of course, airlines depend a lot on, travel passengers, right? Maybe in the 1940s, 50s, 60s, mostly it was, business travelers. But these days, mostly, tourists. A lot of, of course, there are business travelers. But restaurants, they depend a lot on the travel and tourism. But the leverage, the capital structure in these two industries are hugely different. First of all, between restaurant and airlines industry, which one do you think is more likely to be heavily leveraged between the two? Some of you may say airlines. Without deep thinking, it just feels like, right? And this is something you have to, this is the kind of, habit you have to break out of. Just, it feels like. You don't do anything. You don't jump into conclusion because of the spur of your, feel. It feels like. That's the area of mysticism and superstition. It feels like mysteriously. It feels like something mysterious led me to this point. That's something you see only in the movies, in novels. You should be able to logically explain and support your argument. It's not something like something mysterious brought me here. That cannot be accepted, right? You will be laughed at. You will be a laughing stock if you say something mysterious led me to this point, right? You should be able to support and corroborate your argument logically, right? So if you say something like, I don't know, I just got a gut feeling, I had a hunch, something told me, airlines industry. If you say something like that, then you'll be in a pariah. I mean, especially in science, economics, finance, science, technology, engineering, math. You say anything like that, you will be in pariah, right? And so then, why is airlines more prone to higher leverage? Now, think about it this way. You're starting out a restaurant, right? You want to go to and how much? I mean, a restaurant can be a small scale or large scale. But if you're starting out a restaurant, right? You won't start out, generally, it's a small business, right? What can you? The total capital requirement would be not more than $1 million, let's say. Let's say $2 million, right? $2 million. So you think it's a small amount, so maybe it's easy to get a loan, small business loan or something like that. So you go to the bank. What are the chances of getting a loan? What do you think? It's a small amount, so it's easy to get. No, actually, it's going to be very difficult. It's going to be actually more difficult to get a loan than airlines business. You might wonder what to start up an airline. It would cost a huge amount of capital, don't you think? I mean, it's not compared. It cannot be compared to a restaurant, because even a domestic, local airline, domestic airlines, right? I mean, if you're operating between, intra-continental flights from New York to LA, New York to San Francisco, New York to Seattle, New York to Houston, Texas, Miami. A domestic airlines, right? Or even a local regional airline. What is the demand for regional? So mostly domestic, right? Then airplanes would cost. I mean, you have to have a fleet, and a fleet would include, involve a dozen aircraft, like Boeing 737, 777. What would be the price of one airplane, like Boeing 737 or 777? Tens of millions, probably hundreds of millions of dollars. And to have a fleet, and there's times, at least 10 or 12, right? And it's a huge capital. How can you raise that capital? You might say, oh, sell stock. First of all, you're starting up. How can you sell stocks? If you're starting up, you are a big question mark. You're a big question mark, right? But then, how can you raise capital when you're a big question mark? I mean, you're not even listed in the stock market yet. You're not accepted in the stock market, right? Even if you're not listed in the stock market, outside the stock exchange, you can sell like penny stocks. But the penny stocks are that's like when you are privately held, you can sell penny stocks. But what are the chances of an airline that hasn't even started up, right? What are the chances of selling penny stocks and raising capital that way? It's better to start crowdfunding. Now, but the idea is, so raising capital through sale of stocks is just impossible. It's unrealistic, right? But then, is it realistic to get a loan for like almost billions of dollars from a bank? And since you are a startup airline, and will the bank will they lend money to you gladly, even with reservation? Will they? Doesn't seem like it's going to happen, right? But actually, yes, they will lend money to an airline's industry. Why? First of all, remember, it's for the same reason as they lend money to you to buy a car or to buy a house, right? I mean, have you seen these dealership commercials at night? If you watch TV late at night, then you hear these. You see these commercials. You need a car. You have a bad credit. No credit. What do they say? No problem. Why do they say that? No problem. I mean, you have a bad credit. You have derogatory credits history and bad credit, no credit. How can they sell you a car? And you know how financing works. You have to make a down payment, and they say zero down, no problem. You don't have to make a down payment, zero down, right? How can they? What makes it possible for them to sell you a car with zero credit and zero down payment? Huh? That means they are lending you, the entire price of the car and let you have the key. And well, why? For one reason. What is that one? Because the cars become collateral by themselves. So in other words, they're not lending you for free without any collateral. The minute you buy the car with the borrowed money, right, the car becomes the collateral, right? Remember that? So if you miss payment, then they will repossess the car. They will sell it off, right? They will recover the residual value on the car, right? They will put it again for sale, and then they collect, payments again on that, car. And until you miss the payment, then they collect the, you remember the amortization? They get the interest and principal repaid, every month, right? And the same thing with the house, the mortgage. Why do they give you the mortgage? Because the house becomes a collateral automatically. And just like that, in airlines industry, right? If they lend you the money, you buy them, you use them to buy airplanes, right? Boeing 747. They become collaterals already. And if you default, then they foreclose on that on those aircrafts, and they sell it off. They auction off those aircrafts, right? So they get their money back, and then lend the money again to another borrower. And until you default, they collect payment, interest and principal, right? So that's the reason airlines industry is more likely to get the loan, even though it is in huge amount. And compared to that, what does the restaurant industry have to offer as collateral?
All right. So I don't know. I find this type of I find this type of discussion very fascinating, but I don't know, I just couldn't feel the time flying. But the time is 8:14, and I think this is the right point to cut it off. We have about like 6 minutes left on this video, so we're gonna get started on this next Monday. We have 2 more videos next Monday, Monday and Tuesday. And hopefully, we'll get it done by so we're gonna let's call it a night, right? And I will see you guys on next Monday. Don't forget.
Quick question, Professor.
Yeah.
Thank you, Professor. See you next week.
We end this class.
Yeah. See you, Shanaz. Yeah, you are.
Professor, we end this class.
Shanaz.
Professor, we end this class.
Class is dismissed. You may leave.
Professor, question.
Shanaz has asked a question, so I will. You are free to leave. You are excused.
Do you hear me, Professor?
I will answer Shanaz. Okay.
Professor, I haven't asked the question yet. I can't even speak. Someone else is speaking, so I'll just wait.
Right. Shanaz has the floor. Please respect. Right. Shanaz has the floor. Yeah, go ahead.
Thank you. I was gonna ask about. I saw the notification of the interim grade thing. I tried to get into that link, but it wasn't working. So I wasn't seeing anything on that link or whatever, like on the Blackboard where it says the interim grade is here. I couldn't see anything.
Maybe it's your browser issue, right?
Yeah.
Because it will first of all it will download it, right? Because it's an Excel file. So if you click on it, it will download. So make sure the file is downloaded into your download folder.
Okay, Professor. I'll try it again and see. And if anything, I'll just email you.
Right. I can just
Thank you.
Attach it to the email in case. All right. Any other questions? Well, the class is officially dismissed. So you are. So some people are still. It looks like some people are still here. So let's see. We end this class for good Tuesday. Yeah. Tuesday is the last day of the class. Last day of summer 2. Okay. All right, Brandon, you heard me? All right, I guess he heard. All right, take care. Bye, everyone. Stop recording.